Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. A shocking market turnaround as tech titans ignite a rally, but a shadow war emerges with Meta crashing over 11%. Is this a true reversal or a bull trap built on just two stocks? Second, layoffs mask the truth. Amazon skyrockets 10% after cutting 14,000 jobs, signaling a massive Wall Street bet. What is the secret profit engine driving this surge, and is its $125 billion all-in AI gamble a genius move or a bubble about to burst? Finally, crisis looms. 22 million Americans face a 114% health premium surge, threatening a consumer credit meltdown. This isn't just a budget crisis, it's a political paradox. How could this trigger a wave of defaults and a job lock that stifles the entire US economy? Stunning market reversal. Tech titans Amazon and Apple ignite a powerful rally, erasing yesterday's losses and propelling the Nasdaq up 0.6% to 23,724.96. The S&P 500 also joined the upward march, gaining 0.3% to close at 6,840.20, buoyed by a significant sentiment shift among investors. So, what's behind this dramatic turnaround? It's the earnings season magic. Amazon and Apple delivered blockbuster results that transformed investor pessimism into optimism overnight. Amazon's impressive 13% rise in net sales and a standout 20% growth in its AWS cloud division dispelled fears of waning momentum in the AI infrastructure race. Apple's strong holiday season forecast further fueled the fire, setting the stage for continued gains. For investors, this underscores the tech sector's ability to leverage AI investments into tangible revenue growth, a critical metric for future market performance. The dovetailing of these results with a tentative US-China trade truce adds a geopolitical tailwind, reducing some uncertainties that have lingered over the market. Still, not all is clear skies. Meta's hefty capital expenditure projections cast a shadow as its shares plummeted 11.3 to 3% following the announcement. The mixed messages from tech giants highlight the sector's bifurcation, where strategic AI spending can either be a boon or a bane depending on execution. Investors should remain cautious, as the market's recent strength is concentrated within a few mega-cap stocks, signaling potential vulnerabilities. In today's trading, tech was the standout sector. Amazon soared over 9.6% post-earnings, while Apple managed modest gains after initial hesitance, reflecting the market's recalibrated views on their AI strategies. Meanwhile, the technology select sector SPDR fund, XLK, recaptured its footing with a notable rebound. Here's what to watch closely. First, keep an eye on the Nasdaq's 23,500 support level. A breach here could signal broader market weakness. Second, monitor upcoming Fed communications and labor data releases. Any indications of a slower rate cut trajectory could dampen tech sentiment. If you're holding tech-heavy portfolios, stay vigilant for any shifts in AI investment narratives that could sway market momentum. As we move ahead, all eyes will be on the upcoming earnings from Meta and broader economic indicators. These will be pivotal in confirming whether the current optimism is sustainable or merely a fleeting moment in a volatile market landscape. Now let's take a closer look at the specific stories driving today's action. The story begins with a decision that caught everyone by surprise. Amazon announced it's laying off 14,000 corporate employees, and in the same week, its stock soared over 10%. You know, a while back we talked about how markets are great at pricing the next move, but terrible at pricing the next regime, the so-called AI call overpowering broader rate worries. Well, this is that dynamic in action. This isn't a contradiction, it's a sign of a massive strategic shift. It's a textbook example of a powerful economic trend called capital for labor substitution, now supercharged by AI. The key here is that companies are investing heavily in technology to do work previously done by people. This can lead to a jobless recovery where a company's profits and stock price soar even as its workforce shrinks. The market wasn't reacting to the layoffs, but to the stunning numbers behind the curtain. Amazon's total sales blew past estimates, hitting over $180 billion. The real momentum is coming from two divisions. First, Amazon Web Services, the cloud arm, saw sales climb 20% to $33 billion. Interestingly enough, while 20% growth is impressive, it's actually slower than its main competitors. Microsoft's Azure grew by nearly 40% and Google Cloud by over 30% in the same period. This shows the cloud war is shifting. The new battleground is specialized AI services, and Amazon is feeling the heat. But that pressure is offset by this. AWS generated $11.4 billion in operating income. That single division accounted for roughly 2/3 of Amazon's entire operating profit. It's the crown jewel and profit engine funding everything else. The second engine was digital advertising, which quietly surged 24% to $17.7 billion. This rapid growth is significant because it's solidifying advertising as a third pillar of profitability, making Amazon's earnings more stable and resilient. This performance challenges the narrative that Amazon was falling behind in the AI race. But that's not the whole picture. The real turning point is the company going on the offensive, raising its capital spending forecast to a staggering $125 billion for 2025, driven by AI demand. We've seen this before. Tech giants underestimating budgets, then revising them higher. Microsoft, Alphabet, and now Amazon are all in an upward revision cycle. To put $125 billion in perspective, this capital expenditure is a direct investment in future ambition, like data centers and servers. It signals Amazon is all in on the AI capital expenditure arms race. Citigroup analysts forecast that major tech companies could spend over $2.8 trillion on AI infrastructure by 2029. This surge is building a massive privately owned infrastructure advantage for US firms, escalating the tech rivalry with China. So all this raises a pretty obvious question: why the massive layoffs amid record performance? CEO Andy Jassy stated the cuts were not financially driven or due to AI, adding the qualifier, right now at least. His official reason, it's culture. He says the company needs to be leaner to move faster. But that qualifier, right now at least, leaves the door wide open for AI to be the reason for future restructuring. Amazon is executing a huge corporate restructuring while committing to one of its biggest spending sprees ever. Wall Street's message is clear: shed the old to fund an all-in bet on AI. The focal point remains whether these massive bets translate into real productivity and profits, or if this capital arms race is creating a bubble that markets won't forgive when the music finally stops. Speaking of high-stakes gambles, let's shift from the trillions being spent in the tech world to a financial crisis brewing on Main Street. A truly stunning statistic to consider. Health insurance premiums for 22 million Americans are on track to increase by an average of 114%. As Affordable Care Act open enrollment begins, a congressional deadlock over enhanced subsidies is creating what one financial planner calls huge sticker shock. These subsidies, in place since 2021, are set to expire at the end of 2025. The financial stakes are staggering. According to the health policy group KFF, an average 60-year-old couple making $85,000 a year would see their annual premiums jump by over $22,600. A 45-year-old earning $20,000 could see their premiums go from $0 to over $400. This isn't just a personal budget problem, it's a potential shock to the entire consumer credit system. A sudden expense hike like this often forces families to make tough choices, and we could see a rise in delinquencies on credit cards and auto loans, especially in states with high ACA enrollment like Florida and Texas. The situation presents a fascinating duality. On one side, more than half of all ACA marketplace enrollees live in Republican congressional districts. A KFF analysis found that this year, about 80% of all premium tax credits, $115 billion, went to enrollees in states won by President Trump. On the other side, there's a political standoff where the outcome will test fiscal ideology against the immediate financial well-being of a party's own voters. Democrats are pushing to extend the subsidies, while Republicans want to negotiate the issue separately. The consequences could spiral. Experts warn that as people see the new prices, many may not sign up, increasing the uninsured population. If younger, healthier people drop out, it could trigger a classic economic problem known as adverse selection, forcing insurers to raise premiums even more in a vicious cycle. Here's where it gets interesting though. This spiral could affect the US economy in a counterintuitive way. Initially, the way the government's CPI for health insurance is calculated, a drop in what people pay could create a misleading one-off deflationary signal. But after that, the CBO project's premiums will rise steadily by nearly 8% per year through 2034. creating a sustained inflationary headache for the Fed. Another major consequence could ripple through the labour market. The loss of affordable health insurance could reverse the trend of people leaving jobs to start businesses, creating what economists call job lock. This could stifle the entrepreneurship and labour market flexibility that have been key to the post-pandemic economy. The damage may already be done. An expert at the Bipartisan Policy Centre warns that even if Congress reaches a deal, many consumers who see an unaffordable premium might not bother to check again. The immediate focus, of course, is on the shutdown negotiations, but beyond that, the key things to watch will be the final enrolment numbers and how the health insurance industry itself pivots. This crisis could reshape healthcare delivery for years to come.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.